Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending February 24th, 2023. I'm Preston Brent. Thanks for tuning in. This week's theme, well, the market's like a carnival ride. Kind of like one of those old carny rides where you get on and it's a wooden roller coaster and it's shaking and rattling and rolling. And what you want to do is be able to finish the ride having fun without the thing all coming apart. But you don't know if that's going to happen or not. And after all, it is an old carny ride, so you never know. So let's just take a look at what's going on in the markets and just kind of where we could be going from here. So let me just put this on the screen here. And you can see this past week, everybody was in the red. And for the first time this year, the Dow has now moved into the red, giving up some gains. S&P is still up 3.4%. NASDAQ up a healthy, a little over 8.8%. Russell up 7%. We had this past week literally a cascade of upside inflation and growth surprises. It kind of pushed the S&P 500 to its worst weekly loss this year, or actually since early December of last year. And at Friday's close, the index had surrendered about 35% of the rally that it began back last October. It's still up this year, 3.4%, as you can see, but it's taken a pretty good little pause right now. In fact, as I said, the Dow is in the red, negative territory for 2023. But there's an interesting stat I wanted to share with you. If you take 8 stocks, and these are the big ones, Meta, Amazon, Apple, Google, NVDA, Netflix, Tesla. If you take these stocks, they account for about 80% of the year-to-date gains in the S&P. And the other 492, 493 account for only 20% of the gains. So once these stocks stop going up, everything runs sideways to down. Most of the 492 other companies in the index are going sideways to slightly down. So really, the breadth in this market, while it improved since October, is starting to level off and go back down again. You can see the PE ratio, the forward ratio is 17.92. I still think that's a little bit higher than where it should be. The dividend yield, 1.71. 10-year treasury, just slightly under 4%. It's moved a pretty good bit this past week. Earnings yields at 5.6%. And you can see the real yield in red there. It's a minus 0.87. So that means inflation is still killing any kind of yield you're getting out of the S&P, short of any stock gains. We did see this past Friday, too, the personal consumption expenditures. That's the PCE. That index jumped up 60 basis points in January. Now, the expectation was for it to increase 40 basis points. So that's the biggest rise we've seen since August of last year. In fact, what also made it worse is they revised higher December's number, right? So we've got the widely considered to be, by the way, the Fed's preferred inflation gauge. It's moved up, and that's kind of got the markets a little bit agitated right now. We did get consensus expectations. We were expecting a decline down to 4.3, but we're not seeing that. Although we did see consumer expectations was revised higher, or consumer sentiment, I guess. The Michigan gauge of consumer expectations revised higher, and jobless claims came in strong. So we're still seeing some underlying strength in the economy. Now it's just going to be a matter of when all of these interest rate hikes are going to start to affect the markets. Now keep in mind also, the CPI has fallen from last year's high of around 9%, I think, largely due to durable goods and stuck up supply chains. But you guys got to remember that 61% of the CPI number is basically services. And services is climbing at about a 7.6% rate through the end of January. Okay, so that is on the Fed's mind as well. So we've got a lot of agita in the markets right now. Enough, in fact, that the next Fed meeting, which is March 22nd, the Fed fund futures they've increased the chance of a 50 basis point rate hike 27%. Okay, it was 25% and a 0% chance of a 50% basis rate hike. Now it's moved from 0% to 27% that we'll see a 50 basis point rate hike in March 22nd when they announce their policy statement. It's going to be real interesting to see. The other thing that's happened with all of these higher inflation number readings that we're getting is that the so-called terminal rate or the Feds has moved up to 5.5% roughly, right? To almost 5.75%. And that idea that the Feds were going to pause their interest rate hikes, in fact, start to reduce them the end of this year has pretty much gone out the window. So the markets are going through a revaluation process, as I tell our members. That's what we're seeing, right? And that's to be expected. So we've got a lot of agita in the markets right now. Now you can see the best performing sector for the week was energy, only 20 basis points. That's the only sector that was in the green this week. The worst was discretionary, which is a risk on sector. So obviously they took it really bad this past week, down 4.46%. Annually, discretionary is still doing good because it had such a strong move in January, but that's going to slowly work its way back. Meanwhile, utilities is leading the way to the downside, a little over 5.5%. Okay. Now, if we come across the pond and look at what's going on over there, you can see they're doing a little bit better. We're getting the CAC 40, the French markets are up 11%. The DAX, the German markets are up 9.24. You can see everybody solidly in the green. The Euro stocks, which is 50 of the largest companies in Europe, they're up 10%. All right. Now, this past week, everybody was in the red with the exception of China. But outside of that, still a very strong number. Inflation in the Eurozone did pull back a little bit in January to an annual rate of 8.6%. The previous reading was 9.2. So it's pulling back, but it's still a lot higher than the US. The ECB is on record as saying they're going to hike the rates in March, another 50 basis points. They're still behind the US Feds as far as the tenacity of hiking the rates, but they're getting them up there, and Europe's got a lot higher inflation rate than we do here in the US. Okay. So we're seeing strong inflation numbers pretty much worldwide. Although we did get a PMI number, a combined composite PMI, which includes both services and manufacturing. It rose to 52.3 from 50.3 in January. So anything over 50 is expansion, but it's just barely. And as those rates start going up, we're going to see probably the Europe fall into a recession, I suspect. Meanwhile, over in the Asian markets in Japan, Kazao Ueda, who is going to take over as the Bank of Japan governor, like our Boom Boom Powell here in the Fed in the U.S., and Christine Queen Bee Lagarde in the ECB in Europe. Anyway, Ueda is the new Bank of Japan governor in April. He basically calmed the markets by saying it's still appropriate to continue monetary easing. So they're going to continue to ease over there, over in Japan. Meanwhile, in China, as I said, they're the only one up for the week. They've advanced. They've had 3 weeks in a row of losses, right? So, and Japan, I can promise you, China's going to come out with more monetary support for the economy. So really, Japan and China are really the only countries that are, looking at increasing monetary stimulus. All the other countries, the U.S., South Korea, and all over Europe and the UK are looking at tightening and taking money out of the economy. So we'll see how that shakes itself out. What I want to do is shift you over to a couple of charts here that I'm looking at in the markets, just to give you an idea. Let me just swing it over here like this. We're going to take a look at the E-mini S&P 500 futures, just to show you guys where we're sitting right now and where is the risk of a bigger move with the upcoming week coming up. You can see this yellow line, which is the 200 moving average. And then let me just check on it. I want to verify it is the 200 simple moving average, right? Which is a little bit slower to react than the exponential. But you can see on Friday, it came down and the markets found strong support right at the 200 SMA. And you can see we did break, and we're now sandwiched between the 50 and the 200 SMA. Should this break, it won't take much to get us below the 2022 closing price of 38.68 and take us down. All right. So as I've told our members, we've got the bigger risk of a move right now is downside risk. It's not upside risk. And we're giving up a lot of the gain that has moved up, as I said in the opening here. So we've got to be very careful. We got two dates coming up, March 14th and March 22nd. March 14th is the CPI data for the month of February, and then obviously March 22nd, which is the next Fed meeting. Those two are going to drive the markets. Now, CPI comes in first. That'll guide the headline number and the core number for the Feds, and that'll lead us the following week into the Fed number. Those two are enough to completely change the outlook of near-term price action for the next 60 days or so. Okay. So just understand kind of where we are in the tenacity of inflation staying sticky for longer. And if we look at the FANG index, okay, you can see here with the FANG index, we closed this gap up very easily, and now we're sitting right on the 50 EMA. Now, remember, I said the FANG plus a couple of others, and I threw in there NVDA and Netflix and Tesla in addition to the FANG. All of those account for about 80% of the year-to-date gains in the S&P, okay? And the other 492 or 493 companies account for the remaining 20%. So as these guys go, so go the markets. And with inflation being stickier than the Feds thought, and them being forced to be a little bit more aggressive in their rate hikes and driving up the terminal rate towards the end of this year, by probably more than 50 basis points, we're going to see these revaluations continue, right? And that would have a tendency to push the markets a little bit lower. If we do look at the VIX, this is the VIX this past week. Well, let me just get it on the VIX here. You can see with the VIX how it's moved up into the red zone here. We're over the 50 SMA, and we're under the 200, so we can stay stuck here for a while. We do not stay below 20 very long before it moves back up, and it's going to be like this, very choppy, at least through the next Fed meeting. And I suspect it'll probably be like that in the first half of this year. I'm hearing some market participants and some analysts saying that they were forecasting a recession in the first half of this year. They're moving the recessionary tone out to the second half of this year. I'm not convinced either way just yet. But I'm going to let price action dictate our move, as I always do. So this is a little bit about what I'm seeing in the volatility gauge. And of course, if we come down and look at the 10-year Treasury, right here, you can see or let's look at the interest rates. You can see the rates took out that prior pivot high there. It's going to hold up here for a bit. I don't think it's going to get much more than 4.1, 4.2%. At least that's the way it's looking right now. But I see a lot of energy in this move, and you can see that bounce over the 200 SMA right here. So that would imply that any pullback here is still going to be bought. We're going to buy the dip kind of thing, and it's going to move up. All right. So that's a little bit about what I'm forecasting. In fact, my target for the 10-year is out in the summer, almost over 4.5 to 4.9%. I don't know if we're going to get there, but if we do, we are going to have a harder recession rather than a soft one. And then, of course, with the interest rates going up like this, you're going to see the bond market going down. Friday was down over a full handle. I mean, we're back now into the red for the year. All right. And let me just move this down. The new, the lows for 2023 are right here like that. Right. So that would be the lows. I just have to change this on my chart here. Things are moving so quick here that, it's almost like a daily update sometimes on the charts. But you can see this is the 2023 lows. And you can see this move up and then just a roll over, which means interest rates are going higher. And that's all because of the higher inflation numbers that we're starting to see right now. Okay. If we look at the currencies, that means the dollar is going to get stronger. And sure enough, look at this move in the dollar. We're coming close to hitting the 2023 highs in the dollar, which really happened on the 6th of January. And I think it's going to run up and test that 200 SMA right there. Okay. And then we'll get a good idea of where we want to go. Longer term, folks, we want to short the dollar. So this could be a good opportunity. The best way to short the dollar is go long the euro. So if the dollar is going up, the euro is going down. And here we go right here. The euro is close to making lows for the year. I think any lower move here, we're going to want to go long the euro. Now, we've been long the euro back over here in early November, right? Or late October, early November, long the euro. And then as you can see, it's just been a great trade. Our members have done very well with it. I think it's going to come down here and catch a little support, and then it's going to move higher. My target for the euro longer term, if I were to put it out and measure it, I'll just let the chart calculate it like this, is up around 111 to the dollar. But I think it's going to take a while to get there. If we continue to hike like we're hiking, the euro is going to continue to go lower and the dollar is going to continue to go higher. Okay. And we're going to get more information on March 14th and the March 22nd when we get the Feds out. And then, of course, if we look at gold, gold is not like higher interest rates. It just doesn't. And you can see gold now has moved into the red for the year. It's moved below the 50. The 200 is sitting in a support zone down here. It got up to 1975. Now, I do project gold is going to run higher this year, just not right now. All right. I've got a near-term projection of gold sitting right here if I were to do a combination all the way up to about 2072, but not yet. I think we need to see some more activity in the interest rate and inflation market with the Feds or inflation data and get what the Feds are going to do before we get a better bead on gold. Okay. And then, of course, if we come down the energy market, you got a number of geopolitical factors playing on oil. That was my target last year. We came pretty close to it, but this is just a great trade. We got a lot of members that are trading oil, doing fairly well in this one. This is a nice trade for oil. So we'll see how that plays itself out. And then, of course, nat gas, big time money in nat gas. You can see here, we started shorting nat gas all the way up its level here. And I've had some members that got out here with nice profits. I got a couple that stayed in of our user group, and they've just made a killing. I mean, you made a killing all the way down here from up here, but it's just continuing. Now, what I expect to see happen is nat gas come back up a little bit and then roll back over. All right. Natural gas does not have a proclivity to stay up around the 8 or 9 area for a long period of time. And if you know how to trade it using options, it's a great play. It is really a great play in the nat gas market. All right, everybody, that's kind of where we're sitting for the markets this past week. Members, I will see you tomorrow evening for our weekly market watch. We've got a lot of interesting and moving targets here that I'll get a little bit more detail on and some stocks that look nice to me. All right, everybody, have a great weekend. Members, I'll see you tomorrow evening at 8 p.m. Eastern Standard Time. Take care, folks. Ciao.